Before we begin, please remember that this video is for informational and educational purposes only. I am not a financial advisor, mortgage broker, or real estate attorney. The information provided is not intended as financial, legal, or investment advice. Buying real estate and taking on a mortgage involves significant risk. You should always consult with qualified professionals, like a certified financial planner, a licensed mortgage originator, and a real estate attorney in your state, to discuss your specific situation before making any decisions. All examples are hypothetical and for illustrative purposes. You're scrolling through Zillow again, aren't you? It's late, the house is quiet, and you're escaping. You're picturing it. That perfect little cabin tucked away in the mountains, steam rising from your coffee cup on a frosty morning. Or maybe it's a sun-bleached condo just steps from the ocean, where the sound of the waves is your new alarm clock. It's the American dream squared. Not just a home but an escape. A legacy. A place where memories are made. But here's the uncomfortable truth that gets buried under all those beautiful real estate photos. That dream can shatter into a financial nightmare with terrifying speed. And the number one reason it happens isn't a bad location or a leaky roof. It's a fundamental misunderstanding of the single most important tool you'll use to buy it. The second home mortgage. People think it's just another mortgage. A copy and paste of the loan they got on their primary home. That assumption is a catastrophic mistake. It's like thinking a house cat and a tiger are the same animal just because they both purr. They are fundamentally different beasts, with different rules, different risks, and different appetites for your money. And that is exactly why we're here today. This video is going to be your definitive guide to the basics of second home financing in the United States. We are going to demystify this entire process. By the end of this, you will know more than 95% of prospective buyers out there. You'll understand what a second home mortgage truly is from a lender's perspective, how it drastically differs from a primary home loan or an investment property loan, and you'll learn the critical questions you absolutely must ask yourself before you even think about filling out an application. We're going to arm you with the knowledge to protect your finances and turn that dream into a reality, the smart way. So let's start with the most important question of all, the one that everything else is built on. What exactly is a second home in the eyes of a bank? It sounds simple, but this is where the first tripwire is hidden. To you, a second home is any property you own that you don't live in full time. To a mortgage lender, the definition is razor-sharp and non-negotiable. For a property to qualify for the more favorable second home mortgage rates and terms, it generally has to meet a few key criteria. First, it must be for your personal use and enjoyment. This is not a business venture. The lender is underwriting the loan based on the idea that you and your family will be the ones using it for vacations, for weekends, for getaways. Second, it typically needs to be a reasonable distance from your primary residence. There's no single nationwide rule for this, but think about it from the bank's perspective. If you're buying a second home that's only 10 miles away from your main house, it raises a red flag. Are you really going to vacation there? Or are you trying to secretly rent it out to a family member or use it as a full-time rental? Most lenders want to see that the property is far enough away to be considered a legitimate vacation or destination spot, often at least 50 miles, but this can vary. Third, you must occupy the property for some portion of the year. Again, the lender needs to be convinced this is your personal retreat. You can't just buy it and let it sit empty for 365 days a year. And fourth, and this is the big one, you generally cannot rely on rental income to qualify for the loan. While some limited rental is sometimes permissible depending on the specific loan program, a true second home mortgage is underwritten based on your ability to pay for it, without any help from tenants. The moment you say to a lender, "I'm going to rent this out on Airbnb to cover the mortgage," you have fundamentally changed the game. And that brings us to the single most important concept you need to grasp. The three worlds of real estate financing. Every property you could possibly buy falls into one of three distinct categories in the eyes of a lender: primary residence, second home, or investment property. Getting these confused or trying to misrepresent one as another is financial suicide. Let's break them down. First, you have your primary residence. This is your main home, the address on your driver's license, where you get your mail. From a lender's point of view, this is the safest loan they can possibly make. Why? Because people will fight tooth and nail to keep the roof over their family's head. The statistical risk of default is the lowest on a primary home. Because the risk is lower, the reward for you is greater. You get access to the best interest rates, the lowest down payment requirements, sometimes as low as 3 or 5%, and the most flexible qualification guidelines. This is Tier 1, the gold standard. Next, in the middle you have the second home. This is our mountain cabin, our beach condo. The lender views this as a luxury. It's a wonderful thing to have, but it's not a necessity for your survival. Their thinking is simple. If you hit a rough patch financially, lose a job, face a medical emergency, what are you more likely to stop paying for first? The home your family lives in every day? Or the vacation spot you visit a few times a year? The answer is obvious. Because the risk of default is higher than on a primary residence, the terms of the loan are stricter. You will be required to make a larger down payment, almost always at least 10%, and often 20% or more. The interest rate will also be slightly higher than what you could get on a primary home, and the credit score and income requirements will be more stringent. This is Tier 2. Still great, but a definite step up in difficulty. Finally, you have the third world, the investment property. This is a property you buy with the primary intention of generating income. You're not vacationing here, you're a landlord. To a lender, this is a small business and it carries the highest level of risk. Your ability to pay the mortgage is dependent not just on your own finances, but on your ability to find and keep reliable tenants, on local market rental rates, on vacancy periods, and on the costs of repairs. Because the risk is the highest, the requirements are the toughest. Expect to put down a minimum of 20 to 25%. Expect the highest interest rates of all three categories. And expect the lender to scrutinize your finances, your cash reserves, and your experience as a landlord with a microscope. This is Tier 3, the most difficult to finance. Understanding the stark difference between these three categories is everything. Because it leads us to the single biggest, most dangerous mistake people try to make. They find a property they want to rent out, but they see the much better terms offered for a second home, and a little voice in their head says, "What if I just told the bank it was a second home? They'll never know. I'll get a lower down payment and a better rate." Let me be crystal clear. Do not do this. This isn't a clever loophole. It has a name: occupancy fraud. It is a type of mortgage fraud and it is a felony. Lenders are not stupid. They have entire departments dedicated to sniffing this out. They'll check your utility bills. They'll look at where your mail is being sent. They'll check tax records and insurance policies. In today's world, they might even look at your social media posts. If they catch you, and they often do, the consequences are severe. They can call the entire loan due immediately, forcing you to pay back hundreds of thousands of dollars on the spot. They will report you to the authorities, which can lead to massive fines and even prison time. The few $1,000s you thought you were saving is not worth destroying your entire financial future, your reputation, and your freedom. So the first step on this journey is honesty and clarity. You have to know which game you're playing. Are you buying a home to live in? That's a primary residence. Are you buying an escape for you and your family to enjoy personally? That's a second home. Are you buying a property to make money from tenants? That's an investment property. These paths do not cross. Now that you understand this fundamental framework, the three sacred categories of real estate financing, we can move on to the next critical piece of the puzzle. What does it actually take to get approved? What specific numbers are the banks looking for when they pull up your file? We need to talk about down payments, credit scores, and something lenders call your debt-to-income ratio, which is the secret number that makes or breaks most mortgage applications. Let's start with that secret number, your debt-to-income ratio, or DTI. Think of it as your financial blood pressure. It's a single percentage that tells a lender how much of your monthly income is already spoken for by debt. And for a second mortgage, they put this number under a microscope. Here's how it works. A lender takes all of your monthly debt payments, we're talking your current mortgage, car loans, student loans, credit card minimum payments, any personal loans, and they add them all up. Then they add the estimated monthly payment for the new second home you want to buy. They take that grand total and divide it by your gross monthly income, which is what you make before taxes are taken out. The result is your DTI ratio. For example, if you make $10,000 a month before taxes, and all your existing debts plus the new mortgage would add up to $4,500 a month, your DTI would be 45%. Now, why is this the number that makes or breaks applications? Because it's the purest measure of your ability to handle more debt. It's not about how much you have in savings. It's about your monthly cash flow. For a primary residence, lenders can sometimes be flexible, occasionally stretching up to 50% DTI for a strong borrower. But for a second home, the rules get much stricter. Lenders see a second home as a luxury, an optional expense. If you hit a financial rough patch, which mortgage are you more likely to stop paying first? The roof over your head? Or the vacation cabin 3 states away? They know the answer. So, to protect themselves, they set a much lower DTI threshold. Most lenders will draw a hard line at 43%. Many prefer to see it under 40%, and the most conservative ones want you at 36% or lower. If your DTI, including the new property, creeps over that 43% mark, your application is often dead on arrival no matter how good the rest of your file looks. It's the first and most important gate you have to pass through. The second gate is your credit score. We all know credit scores are important, but for a second mortgage, they become less of a guideline and more of a non-negotiable requirement. Your credit score is your financial report card, a history of your promises kept. When you're asking for a second massive loan, lenders want to see a report card with straight A's. You might hear stories about people getting a primary mortgage with a 620 or 640 credit score. And while that's possible, you need to erase those numbers from your mind when thinking about a second home. For this kind of loan, a score of 740 is often considered the gold standard. Can you get approved with a 720? Maybe. A 700? It's getting tough. Below 700? It's incredibly unlikely unless you have some massive compensating factors like a gigantic down payment. And it's not just about getting a yes or a no. Your credit score directly controls the interest rate you'll be offered. The difference between a 750 score and a 680 score could be a full percentage point on your interest rate. That might not sound like much, but on a $300,000 30-year loan, a single percentage point can cost you over $60,000 in extra interest payments over the life of the loan. $60,000. All because of a 3-digit number. Lenders aren't being mean. They're pricing for risk. A lower score signals higher risk, which demands a higher return for them in the form of interest. So a high credit score isn't just a key to the door. It's the key to the VIP room where the best deals are. Okay, so you've got a low DTI and a stellar credit score. You're feeling good. Now we come to the third, and for many people the highest hurdle, the down payment. This is where the world of second homes diverges completely from the world of primary homes. For your primary residence, especially if you're a first-time buyer, you have access to all sorts of programs. FHA loans with 3.5% down. Conventional loans with 3 or 5% down. These programs are designed to make homeownership accessible. For a second home, those programs vanish. They do not exist. Lenders view this as a significant purchase for an established, financially secure buyer, and they expect you to have serious skin in the game. The absolute bare minimum down payment you'll typically find for a second home, like a true vacation home that you and your family will use, is 10%. But even that is becoming rare. Realistically, you should be prepared for 20% down. Putting down 20% allows you to avoid private mortgage insurance, or PMI, which is an extra monthly fee, and it instantly shows the lender that you are a serious, low-risk borrower. Now, it's critical to understand the distinction lenders make between a second home and an investment property. A second home is a place you intend to occupy yourself for part of the year. An investment property is one you intend to rent out for profit. If the property is classified as an investment, the requirements get even tougher. The minimum down payment for an investment property is almost universally 20%, and many lenders will require 25% or even 30%. Why? Because the risk is even higher. They're not just betting on you. They're betting on your ability to be a successful landlord in a market you might not be familiar with. A bigger down payment creates a larger equity cushion for them if things go south. So, on a $400,000 lake house, you need to be ready to write a check for $80,000 plus closing costs. That's the entry fee. But wait, there's one more gate. This is the one that surprises most people, the secret weapon that separates the approved from the denied. Cash reserves. Lenders don't just want to see that you can afford the down payment. They want to know what happens the day after you close. What happens if you lose your job? What happens if your tenant moves out and the property sits empty for 3 months? Do you have enough cash on hand to cover all your obligations without immediately going into default? This is where cash reserves come in. Lenders will require you to have a certain number of months' worth of mortgage payments saved up in a liquid account, like a checking, savings, or brokerage account. And they're not just talking about the payment for the new house. They want you to have enough to cover the PITI, that's principal, interest, taxes, and insurance, for both your primary home and your new second home. How many months? It varies, but it's never zero. The bare minimum is often 2 to 6 months of reserves. So, if your primary mortgage is $3,000 a month and your new mortgage will be $2,000, that's $5,000 a month. 6 months of reserves would mean you need $30,000 sitting in the bank after you've already paid your massive down payment and all of your closing costs. For investment properties or for borrowers who are a little closer to the DTI limit, they might require 12 months of reserves or more. This is their ultimate safety net. It proves to them that you're not stretching yourself to the absolute financial limit to make this purchase. It shows that you have a buffer that you can withstand financial shock. It's the final definitive piece of evidence that you are the kind of low-risk responsible borrower they want to do business with. So there they are, the 4 gatekeepers of the second mortgage world. A low debt-to-income ratio, proving you have the monthly cash flow. A high credit score, proving you have a history of reliability. A huge down payment, proving you have skin in the game. And deep cash reserves, proving you have a safety net for the future. You need to satisfy all 4 of these gatekeepers to get approved. But getting approved is only half the battle. Now you have to choose the weapon. What kind of loan do you actually get? Is a 30-year fix the only option? Or are there other, more creative ways to finance your dream? The type of loan you choose can drastically change your monthly payment and your overall financial strategy. Let's dive straight into the heart of the matter, because this is where a dream can either take flight or turn into a financial nightmare. When you walk into a lender's office, you're not just asking for money. You're choosing a financial partner for the next decade or 3. The loan you select is the engine of your second home investment. Some engines are built for stability and endurance. Others are built for speed and flexibility. Choosing the wrong one is like putting a diesel engine in a Formula One car. It just won't work for your goals. The most common, the one everyone knows, is the conventional fixed-rate mortgage. This is the bedrock of American homeownership. It's your classic 15-year or 30-year loan. The interest rate you lock in on day one is the interest rate you will pay for the entire life of the loan. Your principal and interest payment will never change. Not if the market soars, not if it crashes. It is a pillar of predictability in a world of financial chaos. For a second home, this offers a powerful sense of security. You know exactly what that payment will be every single month for 360 months on a 30-year loan. This makes budgeting for your primary home and your vacation home incredibly straightforward. There are no surprises, no sudden spikes in your payment that force you to cancel a family trip. It's the set-it-and-forget-it option. This is perfect for the buyer who sees their second home as a legacy property, a place they'll keep for decades, maybe even pass down to their kids. They're not playing the market, they're building a future. But that stability comes at a price. Fixed-rate loans typically have a slightly higher interest rate at the outset compared to their riskier cousins. The bank is taking on all the risk of future interest rate hikes, so they charge you a premium for that peace of mind. And if interest rates plummet 2 years after you buy, you're stuck with your higher rate unless you go through the entire costly and time-consuming process of refinancing. So while it's safe, it's not always the most financially efficient tool in the shed. Now let's talk about the option that still gives some people a shiver down their spine. The adjustable rate mortgage, or ARM. The ghost of 2008 still haunts this loan type. But let's be very clear, today's ARMs are not your parents' ARMs. They are a completely different, more regulated, and frankly safer financial product. Here's how a modern ARM works. You'll see them listed as a May 1st, July 1st, or 10/1 ARM. The first number is the key. It's the number of years your interest rate is fixed. For a 7-to-1 ARM, you get a locked-in, low introductory rate for the first 7 years. After that 7-year period, the rate can adjust once per year. That's the one. Based on the market index it's tied to. The huge advantage? That introductory rate is almost always significantly lower than what you'd get on a 30-year fixed mortgage. This means a lower monthly payment for the first 5, 7, or 10 years of ownership. This can free up tremendous cash flow, money you can use for furnishing the home, making improvements, or simply investing elsewhere. So who is this for? This is the loan for the strategic buyer. The person who doesn't plan on holding the property for 30 years. If you know you're likely to sell the vacation home in 5 to 7 years, why would you pay a higher interest rate for 30 years of stability you'll never use? You take the 7-to-1 ARM, enjoy the lower payments, and sell the property before the rate ever has a chance to adjust. It's also for the financially savvy buyer who is confident that they will have the means to refinance into a fixed-rate loan before that adjustment period hits, should they decide to keep the property long-term. The risk, of course, is the uncertainty. While modern ARMs have caps that limit how much your rate can increase in a single year and over the life of the loan it can still go up. If your financial situation changes and you can't sell or refinance when you planned, you could be facing a much higher payment down the road. It's a calculated risk, not a blind gamble. But what if the best way to finance your second home has nothing to do with your second home at all? What if the key is already sitting in your driveway, or more accurately, in the foundation of your primary residence? I'm talking about tapping into the equity you've already built. There are two powerful ways to do this. First is the Home Equity Line of Credit, or HELOC. Think of a HELOC as a massive credit card secured by your main house. A lender will approve you for a certain amount based on your equity, say $100,000. But you don't take it all at once. You have a draw period, usually 10 years, where you can pull money out as you need it. If you need $50,000 for the down payment, you pull $50,000. A month later, if you need $10,000 for a new roof on the vacation house, you pull another $10,000. You only pay interest on the money you've actually used. The flexibility is incredible. For a fixer-upper second home, it's a dream come true. You can fund the purchase and the renovations from the same source without taking out a separate, high-interest construction loan. During the draw period, many HELOCs allow for interest-only payments, keeping your monthly obligation incredibly low. The downside? It's almost always a variable interest rate, meaning your payment can fluctuate from month to month. And the biggest risk of all, you are putting your primary home on the line. If you default on your HELOC payments, the bank can foreclose on the home your family lives in. The stakes are significantly higher. The second way to use your equity is the cash-out refinance. This is a bit more straightforward. Let's say your primary home is worth $600,000, and you only owe $250,000 on your mortgage. You have $350,000 in equity. You could go to a lender and refinance not for the $250,000 you owe but for $400,000. You get a brand new mortgage for $400,000 which pays off your old $250,000 loan, and the bank hands you a check for the $150,000 difference. This is a lump sum of cash you can use as a massive down payment on your second home, or in some cases to buy the property outright in cash, giving you immense negotiating power. The beauty here is that you're rolling everything into one single mortgage payment on your primary home, and that new loan can be a stable 30-year fixed-rate mortgage. It simplifies your finances. But there are two major watch-outs right now. First, closing costs. You're paying to refinance your entire mortgage, which can be expensive. Second, and this is the big one, you are replacing your old interest rate with a new current one. If you were one of the lucky ones who locked in a mortgage at 2.5 or 3% a few years ago, a cash-out refi means giving up that historically low rate for whatever today's much higher rates are. You could be increasing the payment on your primary home significantly for the next 30 years. The math has to make perfect sense. So we have the workhorse fixed rate, the strategic arm, and the powerful equity tapping tools of the HELOC and cash-out refi. Each one is designed for a different person, a different plan, a different risk tolerance. The person buying a rustic cabin to retire in 20 years has a vastly different financial need than the person buying a condo to rent out and flip in 5. Choosing your loan type isn't just a financial decision. It's a strategic one that must align perfectly with the why behind your second home purchase. So you've studied the options. You've weighed the pros and cons. You've picked your weapon of choice from the financial armory. But now comes the next critical question. How much ammunition do you actually need to bring to the fight? We're talking about the down payment. And let me tell you, the rules for a second home are a completely different ballgame than what you remember from your first. That 3% or 5% you might have put down on your starter home. Forget it. For a second home, 20% isn't the goal. It's just the beginning. That's because for a lender, a second home isn't a home. It's a risk. It's a luxury item. Think about it from their perspective. When life throws a curveball, a job loss, a medical emergency, a sudden recession, what's the first major expense people are likely to cut? It's not the roof over their family's head. It's the cabin by the lake. It's the condo by the beach. They know that when push comes to shove, you will fight tooth and nail to keep your primary residence. The vacation home? That becomes a financial liability, and it's often the first mortgage payment to be missed. Lenders aren't just guessing here. They have decades of data to back this up. So they protect themselves. That 20% down payment isn't just a number they pull out of thin air. It's a shield. It's a massive equity buffer that ensures you have significant skin in the game. It makes you far less likely to walk away. And if you do, it gives the bank a much better chance of recouping their money. This isn't some negotiable guideline. It's a fundamental rule of the game, enforced by the very institutions that buy and sell most of the mortgages in America, like Fannie Mae and Freddie Mac. Their underwriting standards are the law of the land, and for second homes the law is simple: you need a substantial down payment. But the down payment, as steep as it is only the first gatekeeper. It's the wall you have to climb just to get into the arena. Once you're inside, you face the next challenge, and for many people this one is even tougher. It's called the debt-to-income ratio, or DTI. Now, you've heard this term before when you bought your first home. It's the simple, brutal math of your entire financial life boiled down to one number. It's all your monthly debt payments, your current mortgage, car loans, student loans, credit card minimums, all of it, added together and divided by your gross monthly income. For your primary home, lenders might have given you some leeway. They might have stretched the limit to 45%, maybe even 50% if you had a great credit score and a stable job. They were willing to bet on you because you were buying a necessity. For a second home, that flexibility vanishes. The DTI requirements are clamped down hard. Lenders are looking for a DTI that is significantly lower, often capping it around 43%, and some are even stricter, preferring to see it under 40%. And here's the critical part people always forget. That calculation includes the brand new mortgage payment for the second home you're trying to buy. This is the tripwire that sends so many second home dreams crashing back to earth. Let's make this real. Imagine a couple, we'll call them Mark and Sarah. They make a combined $180,000 a year, which is a fantastic income. That's $15,000 a month before taxes. They've been diligent. Their primary mortgage is $3,000 a month. They have 2 car payments totaling $900, and some lingering student loans at $500 a month. Their total monthly debt is $4,400. So, their DTI right now is $4,400 divided by $15,000, which is about 29%. They look like a lender's dream. They've saved up $100,000 for a down payment on a beautiful $500,000 mountain cabin they've had their eye on. They've got the 20% down payment covered. They walk into the bank confident. Then the loan officer runs the numbers. The new mortgage on the cabin with taxes and insurance is going to be about $3,200 a month. So the lender adds that to their existing debt. Their new total monthly debt isn't $4,400 anymore. It's $7,600. Now let's recalculate that DTI. $7,600 divided by their $15,000 monthly income. Suddenly, their DTI is 50.6%. The loan officer slides the paper across the desk. Application denied. Mark and Sarah are stunned. They have the massive down payment. They have a great income. What went wrong? They failed the DTI stress test. The lender isn't just evaluating if you can afford the second home. They're evaluating if your entire financial structure can withstand the weight of 2 mortgages simultaneously, with a very low tolerance for risk. They want to see that even with both payments, you are not financially strained. A DTI over 50% is, to them, a flashing red light signaling that you're living on a paper-thin margin. But let's say you're a financial superstar. Let's say you pass the DTI test with flying colors. Your income is high, your other debts are low. You've climbed the down payment wall. You've navigated the DTI gauntlet. You think you're at the finish line. But then the lender introduces you to the final boss: cash reserves. This is, without a doubt, the most overlooked and underestimated requirement in the entire process. Cash reserves are the liquid funds you must have left over after you've paid your down payment and all your closing costs. We're talking about money sitting in your checking, savings, or non-retirement brokerage accounts. This is your emergency fund, and the lender wants to see it. They want to know that if you lose your job the day after you close, you won't immediately default on both of your mortgages. For a primary home, the reserve requirement is usually pretty modest. Maybe 2 or 3 months worth of your mortgage payment. For a second home, it's a different universe. Lenders will typically require you to have anywhere from 6 to 12 months of pity. That's principal, interest, taxes, and insurance for both of your properties. Let's go back to Mark and Sarah and pretend their DTI worked out. Their primary mortgage pity is $3,000. The new cabin's pity is $3,200. That's a total of $6,200 a month for both homes. If their lender requires 6 months of reserves, they need to show the bank that after paying the $100,000 down payment and another $15,000 in closing costs, they still have $37,200 sitting in a savings account untouched. If the lender is more conservative and wants 12 months of reserves, that number doubles to a staggering $74,400. This is the financial trilogy of terror for unprepared second home buyers. A down payment that's 4 times higher than their first, a DTI calculation that leaves no room for error, and a cash reserve requirement that can be larger than the down payment itself. It's a financial triathlon, and you have to be in peak condition to even qualify. This isn't meant to scare you. It's meant to prepare you, because getting approved for the loan is only half the battle. So you've cleared the down payment hurdle, squeezed through the DTI gauntlet, and somehow have the cash reserves of a small dragon. You're golden, right? Not so fast, because now the bank is going to ask you a question. A question so simple, yet so powerful it can change everything about your loan, your interest rate, and your requirements. They're going to ask you, what are you going to do with it? And your answer will determine whether you're playing on easy mode or expert level. This single question about your intent for the property splits the entire mortgage universe into 3 distinct paths. And the path you take is determined by your answer. It's the difference between a pleasant hike, a challenging climb, and a professional-grade mountain expedition. Let's start with the baseline, the control group, the primary residence. This is your home, the place you live day in, day out. It's where your mail goes, where you're registered to vote, the address on your driver's license. From a lender's perspective, this is the safest loan they can make. Why? Because historically, people will do almost anything to avoid losing their primary home. They'll sell their car, eat ramen noodles for a year, and work 3 jobs before they let the bank foreclose on the roof over their family's head. This lower risk translates directly into better terms for you. You get access to the lowest possible interest rates. You can qualify for government-backed programs like FHA loans with as little as 3.5% down, or VA loans with 0% down if you're a veteran. The underwriting process is the most straightforward. This is the easy mode we talked about. It's the standard against which everything else is measured. Now let's move into the category this entire series is about, the second home. This is also often called a vacation home. The key distinction here is its purpose. It is for your personal enjoyment. It's the cabin by the lake, the condo near the ski slopes, the beach house you escape to. You are not buying it with the primary goal of generating income. You might rent it out for a couple of weeks a year to help cover some costs, and we'll get into the weeds on those rules later, but its main function is to be your getaway. From a lender's perspective, the risk has just ticked up a notch. They know that if you hit a major financial speed bump, you lose your job, face a medical emergency, which mortgage are you more likely to stop paying first? Your primary home? Or the luxury cabin you only use 6 weekends a year? It's almost always the second home. It's a want, not a need. Because of this increased risk, the rules of the game change. First, the down payment. Forget about those 3.5% FHA loans. For a second home, the absolute minimum down payment is typically 10%. And frankly, many lenders will be much more comfortable and give you a better rate if you come to the table with 20% or even 25% down. They want you to have more skin in the game. If you've invested a significant chunk of your own cash, you're far less likely to walk away from the property if things get tough. Second, your interest rate will almost always be slightly higher than it would be for an identical loan on a primary residence. We're not talking about a massive jump, but it could be 0.25%, 0.5%, sometimes more. Over 30 years, that small difference adds up to thousands of dollars. It's the price you pay for the bank taking on that extra layer of risk. Third, lenders will scrutinize your ability to carry both properties. They're going to look at your debt-to-income ratio very, very carefully. You have to prove on paper that you can comfortably afford your existing mortgage, your car payments, your student loans, and this new second mortgage, all without breaking a sweat. And finally, there's a common sense rule. Location. The property must be a reasonable distance away from your primary residence. What's reasonable? There's no hard and fast rule. But if you live in a suburb of Dallas and you're trying to buy a second home in the next suburb over, 10 miles away, the lender is going to raise a serious eyebrow. It has to plausibly be a vacation or getaway spot. A house on the coast, a cabin in the mountains, or a condo in a resort area hundreds of miles away makes sense. A nearly identical house in the next town over does not. It smells like you're trying to bend the rules, which brings us to the third and final category. This is the expert level. The professional mountain expedition. This is the investment property. The second you tell a lender, I am buying this property primarily to rent it out and generate income, the entire landscape shifts beneath your feet. You are no longer just a home buyer. You are a real estate investor. You're starting a business, and the bank is your first and most important business partner, and they will treat you accordingly. The risk in their eyes just skyrocketed. Not only is this a property you'd easily walk away from, but its success now depends on the unpredictable rental market and your skills as a landlord. So what does this mean for you? Brace yourself. The down payment requirement jumps dramatically. While you might get a second home with 10% down for an investment property, 20% is often the absolute bare minimum. More commonly, lenders will require 25%, and some even ask for 30% down. This is the single biggest barrier for most would-be investors. You need a massive amount of capital just to get in the door. Next, the interest rates will be the highest of all three categories. Again, it's all about risk. You can expect to pay anywhere from 0.5% to a full percentage point or more above the rate for a primary residence. But the biggest change is a concept called reserves. After you've paid your massive down payment and all your closing costs, the lender wants to see that you still have a significant pile of cash left over in your bank account. These are your cash reserves. Why? They need to know that if your tenant moves out and the property sits vacant for 6 months, you won't immediately default on the loan. They need to know that if the water heater explodes, you can afford to replace it without missing a mortgage payment. How much do they require? Typically, they want to see at least 6 months' worth of PITI, that's principal, interest, taxes, and insurance for the investment property. And many lenders will require you to have reserves covering both your primary home and your new investment property. This can be tens of thousands of dollars in liquid cash you need to have just sitting there. Now, it's not all bad news. There is one major advantage to an investment property loan. You can use the potential rental income to help you qualify. The lender will order an appraisal that includes a comparable rent schedule, which estimates the fair market rent for the property. They won't let you use 100% of that projected income. Usually it's 75% to account for vacancies and expenses, but that extra income can make a huge difference in getting your debt-to-income ratio in line. So you have 3 paths: primary residence, second home, and investment property. The terms get progressively tougher, the down payments get bigger, and the rates get higher. Which brings us to the most important warning I can give you. Looking at these terms, you might be thinking, well, why don't I just say it's a second home to get the better 10% down loan, and then just rent it out anyway? Who's gonna know? Telling a lender you intend to use a property one way when you secretly plan to use it another is not a clever loophole. It has a name: occupancy fraud. And it is a very, very big deal. It's a form of mortgage fraud, which is a federal crime. If you get caught, the consequences are severe. At a minimum, the lender can invoke what's called an acceleration clause, making your entire loan balance due immediately. If you can't pay it, they foreclose. You could also face hefty fines and, in serious cases, even prison time. And don't think you won't get caught. Lenders have ways of checking. They monitor insurance policies, tax records, and utility bills. An anonymous tip from a neighbor is all it takes. The risk is catastrophic, and it is never, ever worth it. You have to be honest and upfront about your intentions from day one. So you need to decide. Are you looking for a personal getaway, a true second home? Or are you looking to become a landlord and run a business? Your answer will dictate everything that comes next. Assuming you've decided that a true second home, that personal escape, is your goal, you're ready to navigate that middle path. But knowing the category is just the first step. Now we have to find out if your finances can actually handle the journey. In the next part, we are going to do a deep dive into the numbers that matter most, the exact credit scores, the debt-to-income ratios, and the hidden asset requirements you need to meet to turn that second home dream into a reality. All right, let's pull back the curtain and look at the raw, unfiltered numbers that lenders use to decide your fate. This isn't just about having a good job. It's about speaking their language, the language of risk. And the first word in that language is your credit score. For a primary residence, you might hear about loans being approved with scores in the low 600s. Forget that. For a second home, that number is a non-starter. You are entering a different league with a completely different set of rules. Think of your credit score as your financial reputation. When you're buying your main home, the lender assumes you'll do almost anything to protect your primary shelter. But a second home? That's a luxury. And in the cold, hard world of lending, luxury equals risk. If financial disaster strikes, which mortgage payment are you going to miss first? The one for the roof over your family's head? Or the one for the cabin in the mountains? Lenders know the answer, and they price that risk into their requirements. So what's the magic number? While it can vary slightly, you should consider a 700 FICO score as the absolute minimum to even get in the door. And honestly, 700 is the C student in this class. You might pass, but you're not getting any awards. To be a serious contender, you need to be aiming for 720, and ideally 740 or higher. That's the A student territory. Why does it matter so much? Because a score of 740 versus a 680 isn't just about getting a yes instead of a no. It's about the cost of that yes. A higher credit score signals to the lender that you are a reliable, low-risk borrower, and they reward you with a lower interest rate. A seemingly small difference, say half a percentage point, can be colossal over the life of a loan. On a $400,000 mortgage, that 0.5% difference could save you over $40,000 in interest payments over 30 years. $40,000. Your credit score isn't just a number. It's a discount code for your mortgage. The higher the score, the bigger the discount. So before you do anything else, you need to know where you stand and take steps to polish that score until it shines. Now let's talk about the big one. The number that trips up more aspiring second home buyers than anything else. Your debt-to-income ratio, or DTI. This is the heavyweight champion of mortgage qualifications. In simple terms, DTI is the percentage of your gross monthly income. That's your income before taxes. That goes toward paying your monthly debts. Lenders look at this ratio as a measure of your capacity to handle more debt. It's their way of asking, is your financial boat already so full that one more payment will sink it? There are two DTI numbers, but for a second home, we're focused on the back-end ratio. This includes everything: your existing mortgage, your car payments, student loans, credit card minimum payments, and, this is the critical part, the proposed monthly payment for your new second home. All of it gets bundled together. The absolute maximum DTI a conventional loan will typically allow is 43%. Some lenders might stretch to 45% for an exceptionally strong borrower, but 43% is the wall. However, for a second home, many lenders get even more conservative. They might want to see you under 40% or even 38%. They want to see breathing room. Let's make this real. Meet Sarah. She's a successful marketing director making a great salary of $12,000 a month before taxes. Her current financial picture is solid. Her primary mortgage, including taxes and insurance, is $3,000. She has a $500 car payment and about $300 in minimum credit card payments. Her total monthly debt is $3,800. So, we take $3,800 divided by her $12,000 income, and her DTI is about 31.6%. She's in great shape. She feels confident. Now she finds her dream lake house. The mortgage, with taxes and insurance, is going to be $2,500 a month. The lender doesn't just look at that new payment in isolation. They add it to her existing debt pile. So her new total monthly debt is her old $3,800, plus the new $2,500. That's $6,300 a month. Now we take that new debt total and divide it by her same $12,000 income. Her new DTI is 52.5%. 52.5%. Do you see what just happened? Sarah went from a rock-solid borrower to an instant denial. That 43% wall just slammed down in front of her. This is the single biggest mathematical hurdle you will face. Your income has to be substantial enough to support the full weight of both households without even creaking under the strain. And there's no way to fudge these numbers. It's a simple, brutal calculation that determines whether your dream moves forward or dies on the vine. But let's say your credit score is stellar, and your DTI is comfortably in the green. You're not done yet. There's one more gatekeeper, and it's the one most people don't even know exists until it's too late. We're talking about cash reserves. This is not your down payment. This is not your closing costs. This is liquid, accessible cash that you must have left over after you've paid for everything else. It's the money sitting in your checking, savings, or money market account on the day you close, and the lender will verify it down to the last penny. Why? Because the lender needs to see a safety net. What happens if you lose your job the month after closing? What if the AC unit at your primary home dies and you have to drop 10 grand to replace it? The lender needs to be confident that you won't immediately default on one or both of your loans. These reserves are their proof that you can weather a financial storm. So how much do you need? For a primary residence, a lender might want to see 2 or 3 months of mortgage payments set aside. For a second home, the requirement skyrockets. Lenders will typically require a minimum of 6 months of reserves. But here's the kicker that catches everyone off guard. They often require 6 months of payments for both properties combined. Let's go back to Sarah's example, and let's pretend her DTI worked out. Her primary mortgage is $3,000 a month. Her new second home mortgage is $2,500 a month. Her total monthly housing obligation is $5,500. The lender wants to see 6 months of that total amount sitting in her bank account, untouched, after the down payment and closing costs are paid. That's $5,500 multiplied by 6. She needs to show the lender she has $33,000 in liquid cash reserves. This is a staggering amount of money for most people. It's the final and perhaps highest hurdle. It's the lender's ultimate stress test. They're not just asking if you can afford the home today. They're asking if you have the financial fortitude to own it through thick and thin, for months on end with no income. You have to prove you have a fortress of cash protecting their investment. This isn't just about qualifying. It's about demonstrating a level of financial stability that is far beyond that of the average homeowner. So the 3 pillars of your personal financial qualification are a high credit score to secure a good rate, a low DTI to prove you have the capacity, and deep cash reserves to prove you have the stability. You need to conquer all 3. Getting approval for a second home mortgage is a declaration that you've reached a significant level of financial strength. So you've passed the personal financial stress test. Your credit is stellar, your DTI is in the green, and you've got the cash reserves. But that's only half the battle. The property you choose has to pass its own equally rigorous inspection by the lender, and the rules for what qualifies as a second home versus an investment property are razor thin, with massive financial consequences. In the next part, we'll expose the critical property requirements and the one mistake that could get your loan application instantly denied, or worse, have the bank call your loan due. So let's talk about those property requirements, because this is where the bank's magnifying glass comes out. They aren't just underwriting you, the borrower. They're underwriting the property's story. And the first chapter of that story is geography. The number 1 rule, the one that creates a clear line in the sand, is distance. A property generally cannot qualify as a second home if it's located in the same immediate area as your primary residence. Think about it from the lender's perspective. If you live in a suburb of Chicago and you want to buy a condo 10 minutes away in the heart of downtown, are you really going to use that as your personal weekend getaway? Or is it far more likely you're buying it to rent out to a young professional? The lender is betting on the latter. While there's no single universal mileage rule written in stone, the industry standard is typically a reasonable distance, which most underwriters interpret as at least 50 miles away from your primary home. Some are even stricter, looking for 100 miles or more. The property needs to be far enough away that it's impractical for a daily commute. This requirement single-handedly prevents most attempts to disguise a local rental property as a second home. The logic is sound. People buy vacation homes to escape to the mountains, the lake, the beach, or a different city entirely, not to a place they could drive to for lunch. Beyond distance, the location and type of property must align with the second home narrative. Is the property in a recognized resort or vacation destination? A cabin near a national park, a condo on a Florida beach, a house in a ski town? These all fit the profile perfectly. The lender can look at the address and immediately understand the appeal. It makes sense. But if you're trying to buy a standard single-family house in a sleepy, non-tourist suburban subdivision 60 miles away, the underwriter is going to ask questions. Why there? What's the recreational draw? If the home doesn't scream vacation, you'll need a very compelling letter of explanation to convince them. The property itself must also be suitable for year-round occupancy. This means it has to be a place you could live in. It needs functioning utilities like electricity, heat, and potable water. It needs to be accessible year-round, not some remote cabin on a road that's snowed in for 5 months. This is why properties like timeshares, houseboats, or mobile homes often don't qualify for traditional second home financing. The lender wants a stable, reliable, and habitable asset. And finally, and this is a deal breaker, you cannot have a rental agreement or property management contract in place for the home at the time of closing. If you're buying a beach condo that's already part of a rental pool, you'll likely need to finance it as an investment property. The lender needs to see that on day one, the keys are yours and yours alone, with no obligation to a tenant or a management company. Now, navigating these requirements is one thing, but deliberately trying to deceive the lender is something else entirely. This brings us to the single biggest mistake you can make in this process, the one that can unravel your financial life. It's called occupancy fraud. Sounds serious because it is. Occupancy fraud is when a borrower intentionally misrepresents their intended use of a property to a lender to qualify for a loan or to get better terms. The temptation is obvious. You see the lower down payment and the better interest rate for a second home and you think, I'll just tell the bank it's my vacation spot, but I'm really going to rent it out full-time on Airbnb and make a killing. You're trying to get the favorable terms of a personal use loan for a commercial use asset. This isn't just bending the rules, it's a federal crime. And if you think you won't get caught, you are severely underestimating the systems banks have in place. At closing, you will sign a document, often called an occupancy affidavit or a second home rider. This is a legally binding statement where you swear, under penalty of perjury, that you intend to use the property as a second home. You promise you will not have any rental agreements in place, that you'll maintain the property for your own use and enjoyment, and that you'll personally occupy it for some portion of the year. Breaking this promise is where the trouble begins. So how do they find out? It's easier than you think. Lenders perform random and targeted audits all the time. They might pull your insurance records and see that you have a landlord policy instead of a standard homeowner's policy. That's a massive red flag. They can check utility records. If the electricity and water usage at your mountain cabin is sky-high year-round, it suggests someone is living there full-time. Conversely, if the usage is near zero for years, it suggests you're not even using it as a second home. They can find your online rental listings on Zillow, VRBO, or Airbnb with a simple Google search of the address. Sometimes it's as simple as returned mail. If they send mail to your second home and it keeps coming back as undeliverable, they know you're not there. The consequences are not a slap on the wrist. If they catch you during the application process, it's an instant denial and you'll likely be blacklisted. But the real nightmare scenario is when they find out after you've closed on the loan. This is where that or worse part comes in. The lender has the right to enact the acceleration clause in your mortgage agreement. This is the financial equivalent of a nuclear bomb. Calling the loan due means the bank demands the entire outstanding mortgage balance be paid back, in full immediately. Not next year, not next month. Now, if you owe $300,000, you need to come up with $300,000 within about 30 days. Most people can't do that, which means the home goes into foreclosure, your credit is destroyed for nearly a decade, and you could be on the hook for the deficiency balance. On top of that, the lender can, and often will, report the activity to the FBI, which can lead to hefty fines and, in egregious cases, even prison time. Now, does this mean you can never rent out your second home? Not necessarily. This is where the nuance comes in, and it's important. Most lenders understand that you might want to rent out your vacation home for a couple of weeks a year to offset costs, like during a popular local festival or the peak ski season. The key is that the primary purpose of the property must remain for your personal use. The general rule of thumb, often reflected in that second home rider you sign, is that you can't rent it for more than a few weeks a year, and you, the owner, must occupy the residence for a greater portion of the year than any renter. For tax purposes, the IRS has a well-known 14-day rule, which often aligns with lenders' thinking. If you rent it out for 14 days or less per year, you generally don't even have to report the rental income. This short-term, occasional rental activity is usually acceptable. It's the full-time, year-round renting, where you never set foot in the property yourself, that constitutes fraud. The bottom line is to be honest. Have a frank conversation with your loan officer. If your plan is to rent the property out for 6 months of the year, then you need an investment property loan. Don't try to game the system. The potential savings on the interest rate are microscopic compared to the catastrophic risk of losing everything by committing fraud. The lines are not blurry here. They are drawn in the ink of a federal legal document you sign at closing. Now that you understand the strict property rules and the dangers of misrepresentation, let's get into the numbers. We've talked about higher down payments and interest rates, but how do lenders actually calculate your debt-to-income ratio for a second home? The math is different, and we'll break down the exact formulas they use to approve or deny you, and how you can prepare your finances for success. All right, let's pull back the curtain on the single most important number in your second home application: your debt-to-income ratio, or DTI. This isn't just a guideline, it's the gatekeeper. It's the cold, hard mathematical formula that stands between you and the keys to that mountain cabin or beach bungalow. And for a second home, the calculation is more complex because the lender isn't just looking at your new proposed payment. They're looking at the entire weight of both homes on your financial shoulders. Lenders actually calculate two different DTI ratios. The first is called the front-end ratio, which is just your total housing expense. For a second home applicant, that means the mortgage payment, taxes, and insurance for your current home plus the proposed mortgage, taxes, and insurance for the new one, all divided by your gross monthly income. But the one they really care about, the one that gets all the attention, is the back-end ratio. This is the big one. It's your total housing expense for both homes, plus all your other recurring monthly debts, car payments, student loans, credit card minimums, all divided by your gross monthly income. This number tells the lender what percentage of your pre-tax income is already spoken for each month. Let's make this real. Forget abstract percentages. Let's run the numbers for a hypothetical couple. We'll call them Mark and Sarah. They're doing well. Together, they bring in a gross monthly income of $15,000. That's the foundation of our entire calculation. Now let's look at their current debts. First, their primary home. Their mortgage principal and interest is $2,800 a month. Property taxes are $500 a month, and their homeowner's insurance is $150. So the total monthly payment for their primary home, what we call PITI, is $3,450. Next, their other debts. They have a car payment of $600. They have a student loan payment of $400. And the minimum monthly payments on their credit cards total $200. So their total non-housing debt is $1,200 per month. Now they've found their dream lake house. The proposed PITI, principal, interest, taxes, and insurance, on this second home is going to be $2,200 per month. So how does a lender see Mark and Sarah? Do they see a safe bet or a risky proposition? Let's do the math exactly as an underwriter would. First, the underwriter calculates their total proposed housing cost. This is the crucial step. It's not just the new payment, it's both. So they take the $3,450 for the primary home and add the $2,200 for the new lake house. Their total monthly housing obligation would be $5,650. Now we calculate their back-end DTI. We take that total housing cost of $5,650 and we add their other debts, which were $1,200. That gives us a grand total of $6,850 in monthly debt obligations. The final step is to divide that total debt by their gross monthly income. So $6,850 divided by $15,000 equals 0.456. To turn that into a percentage, we move the decimal 2 places, which gives us a back-end DTI of 45.6%. So what does that number mean? For most conventional loans, especially for a second home which is seen as a luxury and therefore a higher risk, lenders draw a very firm line in the sand. The magic number is often 43%. Some lenders might stretch to 45% if the borrower has a massive down payment, a near-perfect credit score, and significant cash reserves. But many are even stricter, capping it at 41% or even 38%. At 45.6%, Mark and Sarah would almost certainly be denied. Their income, while high, is simply stretched too thin by the combination of their existing life and their new dream. This is the moment of truth for so many applicants. They feel financially comfortable, they've saved a down payment, but they get tripped up by this unforgiving formula. So, if you're in a position like Mark and Sarah where your DTI is on the bubble or just over the line, what can you do? This is where you can take control. You have 3 levers you can pull to change the outcome. Lever number 1. Attack the numerator by reducing your total monthly debt. This is the most powerful and immediate lever you have. Look at Mark and Sarah's debts. They have a $600 car payment. If they could aggressively pay off that car loan before applying for the mortgage, that $600 a month disappears from the DTI calculation. Let's rerun the numbers. Their total debt would drop from $6,850 to $6,250. Now, when we divide that by their $15,000 income, their DTI becomes 41.6%. Just like that, they've gone from a definite denial to a strong candidate for approval. Paying off a single loan can fundamentally change your entire application. The same goes for credit cards. Even if you can't pay them off entirely, reducing the balances will lower the required minimum payments, which chips away at your DTI. The 6 to 12 months before you apply for a second mortgage is not the time to finance a new car or buy furniture on a store credit card. You need to become a debt minimalist. Lever number 2. Bolster the denominator by increasing your income. This one is obviously harder and takes more time, but it's still a factor. If you're expecting a significant raise or a promotion, it might be wise to wait until that new, higher salary is reflected on your pay stubs for a few months. Do you have a side hustle? Lenders will often consider that income, but you need to prove it's stable and reliable. That usually means showing 2 full years of that income on your tax returns. You can't just show them a few recent deposits and expect them to count it. It needs to be documented, consistent, and proven over time. Lever number 3, and this is a big one. Adjust the new proposed housing payment. If the math isn't working, you might simply be trying to buy too much house. Looking at a slightly less expensive property could lower that proposed PITI enough to slide you under the DTI limit. But the more strategic way to do this is by increasing your down payment. Remember, a larger down payment means a smaller loan amount. A smaller loan amount means a smaller monthly mortgage payment. Let's go back to Mark and Sarah. Say they were planning a 20% down payment, but their DTI was too high. If they could scrape together enough cash to make a 30% down payment instead, their loan amount would drop significantly. That could easily shave $300 or $400 off their proposed monthly payment. That alone could be enough to drop their DTI from that 45.6% danger zone into the low 40s, making them a prime candidate. Now, I know what many of you are thinking. What if I plan to rent out the second home on weekends or for a few weeks in the summer? Can't I use that potential rental income to help me qualify? This is one of the biggest points of confusion, so let me be crystal clear. For a loan that is officially classified as a second home mortgage, the answer is almost always a hard no. The very definition of a second home loan is that it's for your personal enjoyment and use. The underwriting is based on the assumption that you, and you alone, are responsible for 100% of the payment. You cannot use projected, or even guaranteed, rental income to offset the debt. If your primary intention is to generate income, you're not looking for a second home mortgage. You're looking for an investment property mortgage. That is a completely different product with different rules. It requires a larger down payment, typically 25% or more, has a higher interest rate, and has much stricter requirements for cash reserves. On an investment property loan, you can often use projected rental income to qualify, but you're playing in a different league. So for the purpose of getting a second home loan, you have to prove you can afford both houses, in full, without a single dollar of help from a potential renter. Your DTI is the gatekeeper. It's not a reflection of your worth or your financial savvy. It's a simple risk calculation for the lender. By understanding how they do the math, you can prepare your own finances, pull the right levers, and transform your application from a borderline case into a slam dunk approval. But getting your debt-to-income ratio in line is only half the battle on the financial front. Even with a perfect DTI and a hefty down payment, there's another hidden cash requirement that sinks a surprising number of applications. We're talking about reserves, the liquid cash you need to have in the bank untouched after you've paid your down payment and all your closing costs. How many months of mortgage payments for both houses does the lender need to see? The number is higher than you think, and it's the final piece of the financial puzzle we need to solve. Most lenders, especially on a conventional second home loan, are going to look for a minimum of 6 months of PITI, that's principal, interest, taxes, and insurance for both of your properties sitting in a liquid verifiable account. And honestly, 6 months is the best case scenario. Many of the more conservative lenders, or lenders dealing with jumbo loans or slightly riskier borrower profiles, will demand 12 months. Some even go as high as 18. Let's just pause and let that sink in. After you've scraped together a 20 or 25% down payment, after you've accounted for thousands, maybe tens of thousands in closing costs, the bank wants to see you holding an additional year's worth of mortgage payments for 2 houses, in cash. This is the single biggest shock for most aspiring second home buyers. It's the final wall that many people run into because it feels completely counterintuitive. You've just proven you have a stable income, a fantastic credit score, and a low debt-to-income ratio. You've handed them a massive down payment, significantly reducing their risk. Why on earth do they need you to prove you can pay the mortgage for a year without any income at all? The answer lies in understanding the cold, hard psychology of a mortgage underwriter. Their job is not to believe in your dreams. Their job is to anticipate your nightmares. They are paid to be professional pessimists. And when they look at a second home loan, one thought process overrides all others. They call it the first-to-go principle. Imagine your life takes an unexpected turn. The company you work for has massive layoffs and you lose your job. Or a sudden medical emergency creates a mountain of unforeseen bills. You're in a financial crisis. You look at your monthly expenses and you have 2 massive mortgage payments to make. One is for the roof over your family's head, in the school district your kids attend, in the community you've built your life in. The other is for the lake house, the ski condo, the beach bungalow. Which payment do you miss first? You know the answer. And the lender knows it too. Every single time, the vacation home is the first liability to be jettisoned. It's a luxury, and in a true financial storm, luxuries are the first things to go overboard. The second home mortgage is, by its very nature, a higher risk for the bank. They know that your loyalty, your survival instinct, is tied to your primary residence. So the cash reserves are not a sign of their trust in you. They are the opposite. They are the bank's insurance policy against your potential desperation. They are a tangible guarantee that if you lose your job the day after you close, they will still get their money for at least 6 to 12 months while you figure things out. It's a buffer, a moat of cash protecting their investment from the chaos of your life. So how do you calculate this number? It's brutally simple. Let's build a realistic scenario. Say your primary home's all-in pity payment is $3,000 a month. You found a perfect cabin in the mountains, and after your 20% down payment, its pity is going to be $2,000 a month. Your total monthly housing obligation is now $5,000. If the lender requires 6 months of reserves, you need $5,000 times 6. That's $30,000. This is the amount you need to have in the bank, in a liquid account, after your down payment and closing costs have been paid. If that same lender is more conservative and requires 12 months of reserves, you need $5,000 times 12. That's $60,000. In cash, just sitting there. Let's add it all up. On a $400,000 second home, you might need $80,000 for the down payment, another $10,000 for closing costs, and now another $60,000 for reserves. Your total cash to close just went from $90,000 to $150,000. This is the real math of buying a second home. This is the number that separates the dreamers from the buyers. Now, what exactly counts as reserves? This is where people get into trouble. The lender wants to see liquid assets. That means cash. Your checking account, your savings account, a money market account, that's the gold standard. What about your investments? Your brokerage account with $100,000 in stocks? Lenders will often consider it, but with a major caveat. They will apply a haircut. They know the stock market is volatile, so they might only count 70% of the account's value. That $100,000 portfolio? In the underwriter's eyes, it's only worth $70,000 in reserves. They are building a buffer against a market crash happening at the same time you lose your job. Remember, professional pessimists, what absolutely does not count? Retirement funds. Your 401k, your IRA, to a lender, this money is basically untouchable. They know you'd have to pay massive taxes and penalties to access it, making it a terrible source of emergency cash. They want to see money you can get to immediately without consequence. Also, the equity in your primary home doesn't count. Neither does the value of your cars or your watch collection. It has to be cash or cash equivalents. And there's one more rule that trips people up: the seasoning requirement. Lenders don't just want to see that the money is in your account, they want to see that it's been there for a while, typically for the last 2 to 3 bank statement cycles, so 60 to 90 days. Why? They need to know the money is yours and isn't a short-term loan you have to pay back. If you suddenly get a $50,000 wire from your parents a week before applying, that's a giant red flag for an underwriter. They'll see that large, unsourced deposit and demand a gift letter, signed by your parents, stating that the money is a true gift and not a loan. They need to be sure you aren't secretly taking on more debt to qualify for their debt. By having the money season in your account for a few months, it becomes part of your established financial pattern, making the underwriting process infinitely smoother. So the strategy here is clear. The hunt for a second home doesn't start on Zillow. It starts with a savings plan, specifically for your reserves. This is a separate bucket of money from your down payment fund. You need to calculate the potential pity of your future homes, decide whether you want a 6 or 12-month cushion, and start building it methodically. And while this requirement might feel like an unfair burden, a gatekeeping tactic by the banks, I want you to reframe it. This isn't just the bank protecting itself. This is the bank forcing you to protect yourself. They are forcing you to adopt the financial discipline required to own 2 properties. Because if the thought of having $100,000 in cash sitting in a savings account makes you anxious, imagine the anxiety of having 2 mortgages to pay every single month with no safety net. Having those reserves means you can handle a major, unexpected repair at one house without jeopardizing the other. It means a job loss doesn't immediately become a catastrophe where you could lose both homes. The bank's requirement is actually a blueprint for responsible ownership. We've now completed the financial gauntlet. We've talked DTI, credit, down payments, and the final boss, cash reserves. We have built the exact financial profile a lender needs to see to say yes. You now know with mathematical certainty what it takes to get approved. But we've spent all this time proving you can buy a second home. In the final part, we're going to ask the most important question of all. Should you? We'll explore the hidden costs, the lifestyle changes, and the exit strategies that nobody talks about to help you make a decision you won't regret. We've covered the what, the where, and the how. We've navigated the complex world of financing and the strategic differences between a vacation home and an investment property. But now we have to move beyond the spreadsheets and the loan applications, because the ability to get a second mortgage is not the same as the wisdom of doing so. This is where the dream meets the reality. So let's talk about the true cost of ownership, and I don't just mean the mortgage payment. I'm talking about the phantom costs that haunt a second home budget. First up, the 1% rule. Financial advisors often suggest budgeting at least 1% of your home's value for annual maintenance. On a $500,000 lake house, that's $5,000 a year. $5,000 every year just for the things that will inevitably break, leak, or wear out. That's the new water heater, the deck that needs restaining, the mystery leak in the guest bathroom. And that's a baseline. For older homes or properties in harsh climates, think coastal salt spray or heavy mountain snow, you might need to budget 2 or even 3%. Suddenly, that's $10,000 to $15,000 a year before you've even paid for electricity. Speaking of which, let's talk utilities. You're not just paying one set of bills anymore. You're paying two: electricity, water, gas, sewer, trash collection. And here's the kicker. You pay them even when you're not there. You have to keep the heat on low in the winter to prevent pipes from bursting. You might need to run the AC in the summer to stop mold from growing. And internet? In some beautiful remote vacation spots, reliable high-speed internet can be surprisingly expensive, if it's available at all. These are not small incidental costs. They are a constant monthly drain on your cash flow. Then there's the cost of furnishing the place. This is the budget item that people underestimate the most. You're not just buying a couch and a bed. You're buying a second life. That means a second set of everything: towels, sheets, pillows, blankets, forks, knives, spoons, plates, glasses, a coffee maker, a toaster, a microwave, lamps, trash cans, cleaning supplies. And what about the outside? A lawnmower, a rake, maybe a snowblower, patio furniture, a grill. It's like setting up your first apartment all over again. But this time, you're not surviving on mismatched items from your parents' basement. The cost to comfortably furnish a 2 or 3 bedroom home can easily run into the tens of thousands of dollars. And we can't forget insurance. Insuring a second home is almost always more expensive than insuring your primary residence. Why? Because from the insurer's perspective, it's a higher risk. The property is vacant more often, making it a bigger target for theft or unnoticed damage, like a slow water leak. And depending on the location, you may need specialized, expensive policies. Flood insurance for a coastal property, wildfire insurance for a cabin in the woods. These policies can add thousands to your annual expenses. Add it all up: the maintenance, the dual utilities, the furnishings, the hire insurance, the property taxes we've already discussed, plus the cost of traveling to your second home, and the true cost of ownership can be double or even triple your base mortgage payment. This is the number you need to be honest with yourself about. But the most significant costs aren't always financial. Let's talk about the cost to your lifestyle. There's a phenomenon I call the vacation obligation. You've poured hundreds of thousands of dollars and immense effort into this beautiful place. Now, you feel a deep psychological pressure to use it. Every long weekend, every holiday, every week of vacation time. The default answer becomes, we should go to the house. It sounds great, but it can become a golden cage. The spontaneous trip to a new city? The desire to explore a different country? Those often get sidelined because you feel guilty not using the expensive asset you're paying for. Your world of travel possibilities can, ironically, shrink to the few hours drive around your second home. You have to ask yourself, do you want the same vacation year after year? For some, that's the dream. For others, it's a trap. Then there's the reality of the work. The fantasy is sitting on the deck, sipping a cold drink as the sun sets. The reality is that you arrive on a Friday evening after a long drive, and the first thing you have to do is mow an acre of overgrown grass. The next morning, you have to fix the running toilet, clear the gutters, and pull weeds. A second home is not a hotel. There is no staff. You are the maintenance crew, the cleaning service, and the groundskeeper. It can start to feel less like a retreat and more like a second, unpaid job that you have to drive 3 hours to get to. Are you trading the stress of your work week for the stress of weekend chores? And finally, we have to talk about the exit strategy. This is the single most overlooked part of the second home dream. People are so focused on getting in, they never think about how they'll get out. Life is unpredictable. You could face a job loss, a health crisis, a divorce. The kids who love the lake house grow up and move across the country. The mountain cabin that was a joy in your 50s becomes a burden in your 70s. What happens then? Your exit strategy has 3 main doors, and none of them are as simple as they seem. Door number 1, you sell it. But second home markets are different. They are often highly seasonal and far less liquid than primary home markets. It can take much longer to sell a vacation property, especially if the economy takes a downturn. You might have to hold on to it, paying all those costs for 6 months, a year, or even longer while you wait for the right buyer. And don't forget capital gains tax. If the property has appreciated significantly, you could be facing a massive tax bill, as the primary residence exclusion doesn't apply. Door number 2, you rent it out. This seems like a great solution. Let it pay for itself. But turning your personal retreat into a short-term rental business is a massive shift. You're no longer a homeowner. You're a landlord, a hospitality manager. You have to deal with marketing, booking, cleaning, local regulations and taxes, demanding guests, and unexpected damage. It's not passive income. It's an active business. And are you prepared for strangers to be using your personal items and sleeping in your beds? Door number 3. You leave it to your kids. This is the romantic vision, the legacy, the family cabin that will be enjoyed for generations. The reality can be a nightmare. Your children might live in different states, have different financial situations, and different levels of interest in using or maintaining the property. Who pays the taxes? Who fixes the roof? What happens if one child wants to sell their share and the others don't? A second home intended to bring a family together can become the very thing that tears it apart in probate court. If this is your plan, you absolutely must work with an estate planning attorney to set up a trust or an LLC to govern the property's future. So, is a second home mortgage right for you? After everything we've discussed, the answer has very little to do with interest rates or loan-to-value ratios. The real question is this: what kind of life do you want to live? If you've run the numbers honestly, if you see the maintenance as a labor of love, not a chore, if you crave the stability and deep connection that comes from returning to a special place time and time again, and if you have a clear plan for the future, then a second home can be one of the most rewarding investments you ever make. It can be the backdrop for a lifetime of your most cherished memories. But if you're stretching financially, if you value spontaneity and global travel, if the thought of weekend chores fills you with dread, or if you haven't had the tough conversations about an exit strategy, then a second home can become a financial and emotional anchor, weighing you down instead of lifting you up. The goal is not to scare you but to prepare you, to move you from a dreamer to a planner. A second home can be a gateway to your best life, or a beautifully furnished cage. The difference is in the questions you have the courage to ask and answer honestly before you ever sign the papers. If this series has given you the clarity you need to make a smarter decision, do me a favor and hit that like button, and subscribe for more deep dives that go beyond the surface level advice. Thank you for joining me on this journey. Now go have those honest conversations